So hello and welcome to the Jefferson Educational Society's digital programming. I'm Ben Speggen and I'm the Vice President at the Jefferson and am a contributing editor at the Erie Reader. Joining me in conversation for this program is Dr. Camille Busette. Dr. Busette is the Director of the Brookings Institution's Race, Prosperity, and Inclusion Initiative and a Senior Fellow in Governance Studies with affiliated appointments in Economic Studies in the Metropolitan Policy Program. Camille has dedicated her career to expanding financial opportunities for low-income population. She came to Brookings from the consultative group to assist the poor, CGAP, where she served as the organization's lead financial sector specialist. Previously, she worked with the Consumer Financial Protection Bureau, CFPP, a U.S. government financial services regulator, where she served as the agency's inaugural head of the Office of Financial Education. She's done plenty much more, which you can find a full bio on her website, on her page on the Brookings website. And she is no stranger to Erie, as we were mentioning right before we got started with this program. She was the kickoff presenter for Global Summit 11 that the Jefferson hosted, and that was back in October 2019. My, what a few months it's been since then. But recently, she has co-authored the report, Improving the Equity Impact of the Fed's Municipal Lending Facility, with her colleague Aaron Klein, a fellow at Brookings in the Economic Studies Division, who's also the policy director for the Center on Regulation and Markets. And they lead that piece off with, and I quote, on April 9th, 2020, the Federal Reserve took the unprecedented step of establishing a Municipal Liquidity Facility, an MLF, that will offer up to $500 billion in lending to states and a handful of cities and counties. She and her colleague wrote in their lead to that report, adding, and I quote, both the substance and the speed are welcome, given the crushing impact healthcare, extraordinary public expenditures, and lost revenue are having on state and local finances. However, the MLF's proposed eligibility criteria unintentionally deepened what are becoming disturbing and obvious racial disparities of COVID-19. To unpack that, the Municipal Liquidity Facility and the racial disparities highlighted and exposed through the COVID-19 crisis, Camille and I will discuss the findings of her report in conversation here. Since this program is first airing live on the Jefferson's Facebook page, we'll work our way through as many questions from you, the viewers, as we can as we host this event. If you do have a question, just leave it in the comment section below and we'll do our best to get to them. If you're watching this broadcast at a later date, please do feel free to send us questions and we'll do our best to get them along to Camille as we can. And of course, for more information about upcoming Jefferson Educational Society programs and publications, please do visit www.jeserie.org and like us on Facebook and follow us on Twitter and Instagram. Dr. Camille Busette, thank you for joining us today for this program on the Jefferson.
Hi, Ben. It's so great to be back in Erie, actually, and to be back here at the Jefferson Educational Society. Thank you so much for inviting me. I'm just absolutely thrilled to be back.
We're thrilled to have you. It was such a fascinating and insightful look for the Global Summit. It was a great time to have you there, and we're grateful for the work that you're continuing to do through this crisis, reporting on it, and we're just so grateful that you're joining us here to be able to discuss some of that with our audience today.
No, thanks very much. It's just, as you said, a very, very different world than when I came up in October, unfortunately.
It is, and one of the things that I think is so fascinating about these times now is the way that we can use the crisis to shine a light on disparities and inequities and really perhaps maybe not return to the normal, but find a way to be better as we work our way through this and prepare for whatever lies ahead. And in that intro that I read, Federal Reserve, unprecedented step, Municipal Liquidity Facility, and MLF. For those who haven't had the chance to read your report yet, which we will put a link to in the comment section below, and we'll make sure that's available on the Jefferson's website as well, coupled with this video. Camille, could you briefly unpack the MLF and why that is an unprecedented step for the Federal Reserve?
Sure. I'm going to start with the basics because this is kind of a little technical field, and I think it's important for people to understand that in order for states and local governments to be able to pay for things like their educational system, their police, their health services, et cetera, they actually collect taxes, and they also get loans that are based on state or municipal bonds. So that's a very important part of how state and local governments pay for the services that they give citizens. What was becoming really clear in the last month or so is that states and local governments are starting to have a really hard time making those services available because their budgets are really getting strained. Obviously, they're getting strained because of health reasons, but also because of some things that have been happening in that municipal bond market, essentially. And so what that has meant is that the amount of money that was available for them, so if they had a bond that they wanted to get lenders to buy, the amount of money that was actually available to buy those bonds was actually tightening up a lot. And that's a really important part of how our economy functions. And so the Federal Reserve stepped in to create more money, more cash actually available for states and local governments. So what happens under this program is that states and local governments who qualify, meet the requirements, sell bonds, they're called notes, and they sell them to the Federal Reserve. And it's a loan, essentially. It's a collateralized loan. And so this is not free money for states and local governments. This is actually money that they will have to pay back after some period of time. Really, really important to have that money, because without that, they can't produce any of the services that they're producing now. So what happened in this case is the Federal Reserve stepped in to create that amount of money flowing for states and local governments. And it's unprecedented because the Federal Reserve has never done that before. It has never created a lending facility. That's what we call it. It's a technical word for creating, money for states and local governments to get so that they can get loans from the federal government. They've never done that for states and local governments. Usually that's just done on the municipal bond market. So it's unprecedented in that sense.
And so why? And what really got their attention to say, we've got to act now, and we have to make this amount of money available for states and counties and cities?
Well, a couple different things. So as we all know, many states have pushed back the collection of their annual tax revenue. So most states would be getting that tax revenue in April, like April 15th. Of course, when they push that back, they have less revenue to work with. So that's number one. Number two, the COVID-19 crisis itself has really stretched state budgets. So they've had to pay for ventilators, PPEs, healthcare workers, contact tracing, a whole host of very specific COVID-19 related expenses that they were not anticipating. So that's number two. And then number three, there are lenders that actually buy state and municipal bonds. Generally, there are a set of lenders that buy those, and those lenders were starting to sell those bonds, which meant that they were not going to be buying more bonds. So the amount of capital that would normally be available from those lenders was now shrinking. That combination made it really pretty important for the federal government to step in to create basically a pool of money that state and local governments can borrow from.
And in doing this, we see a quick reaction and quick movement to try to do something really good, but it doesn't come without its consequences. And I want to quote from the report, and I don't want to give away all of the report, because I do want to encourage people to go and read that. But I do want to quote from this and say that, quote, "We are not suggesting," this is what you and Aaron Klein write, "we are not suggesting that the Fed had racist intentions when setting this limit." And I want to get into the limits, but you say, "To the contrary, everything suggests that the Fed was just acting quickly in an unprecedented area. The Fed has long objected to aiding municipal and state governments for good reason. Quick action can have unintended consequences, and the Fed has time to fix this one." That unprecedented step did come a month ago, more than a month ago, on April 9th. What's happened since?
Okay, so a couple things, really encouraging things have happened. So first of all, the state and local government municipal liquidity has become less tight as a result of the Fed action, which is good. But what's interesting is that as soon as the Fed put out its announcement of this particular lending facility, a range of actors actually reacted to it. So you had state and local governments reacting to it, and you had a number of people who are actors in the municipal bond market also reacting to it. Overall, the reactions were a little bit critical, not necessarily about the sort of racial impact, but on impact on states and local governments. And essentially, what the critique was that there were some very large cities and very large municipalities who did not qualify under the original set of requirements. That plus the critique that we provided around the unintended sort of racial impacts of the original formulation of the Municipal Liquidity Facility led the Fed to rethink how it was actually going to roll this out. And the good news is that on April 27th, so about 3 weeks later, it said it would open the facility now to U.S. counties with at least 500,000 residents and U.S. cities with at least 250,000 residents. So it basically brought the million, the requirement was you had to have 1 million or more residents, and it brought down the number of residents. And so therefore, the number of local governments that could qualify, cities and counties that could qualify, increased dramatically. I do want to say one thing about our report, which is that the Fed was really moving fast to address a very serious situation. And I have worked in a federal agency, and I know that when they're moving really fast, they're meeting around the clock, and they're trying to do their best to get something out. And they wanted to signal that these municipal and local governments should not really worry about money. That's really what they wanted to signal. And so they rolled it out, right? And it's sort of like the beta version. And then the beta version got a bunch of critiques. And they then released, the sort of, okay, here's our final version for now. So they were not intending at all to have the kinds of impacts that were highlighted by a variety of different critiques, ours included. But so when you move fast, you make mistakes. But the thing about the Fed is, whatever their initial program is, they can always go back and tweak it. And they did that in this case. And I think that was an excellent move.
Well, and I think that's part of the unprecedented times is that we don't often think about governmental structures moving quickly. That often they're designed inherently to move slowly, to make sure that everything is thought out, everything is debated, everything is discussed, and compromises are made. And we just simply don't have time for that. And so it's good to see that we have the time for revision. And I don't want to underscore, what a significant opening that was to adjust the population. I don't want to put you on the spot to say the exact numbers, but I know prior you had mentioned in the report that under the initial eligibility criteria, only 10 cities and 15 counties across the country had direct access to that. So that was significantly limited when it came to the initial rollout of the MLF.
Right, that's correct. And now far more cities do have access to it. One thing I want to mention is that one of the reasons we were particularly concerned about the original eligibility requirements is that the way it was going to work was that, let's say Baltimore, I'm just going to pick that as my example for today, but let's say Baltimore, which did not qualify under the initial eligibility requirements, needed to raise capital. What Baltimore would have to do is Baltimore would have to go to the state, and the state of Maryland would then have to create a lending facility for that. And as you can imagine, often there are politics involved when a locality is going to the state asking for a lending facility. So it's not just a treasury function. There's a lot of negotiation involved. So I'll just say that Baltimore is predominantly a Democratic city. And the state government in Maryland, at least the governor's mansion, is held by a Republican. Now, Larry Hogan is known to be, a pretty, I would say, mainstream and moderate Republican. But it's important to note that that would have Baltimore would, for instance, would have to have negotiated all that. And so our concern was that every state, every locality would then have to go to their state government and negotiate that, and that politics would really come into play. And what would more likely happen is the less influential they were at the state level, the less likely they would be to get the actual funds. And we were concerned about that because the COVID-19 crisis has really hit African American cities particularly hard. And so if they were in a less advantageous negotiating position, these very hard hit cities would also be the ones who would lose out to potential lending facilities.
Well, and I have to think too that there would be such a bottleneck of now these municipalities all at the same time trying to work with the state and push that through, that just that adds an additional layer of complication and potential delay to get the funding that's designed to be there. Do you think that the Fed is going to go back and revise it yet again and adjust around population numbers? Or is there any signaling that they're going to take another look at this?
So I think what the adjustment that they made is actually really excellent. I don't think they will need to go back to adjust the population numbers. I think they may go back and adjust the terms of the loans, so the length of the loans. And the reason I say that there might be an adjustment there, this is not, I don't have any inside knowledge, so I just want to make sure I'm not, influencing the market or anything like that. I don't have any inside knowledge, but the reason I think that they might go back and adjust the terms is that this crisis is looking a lot more prolonged than it looked at on April 7th. And I think as it's been well popularized that yesterday, Jerome Powell, the head of the Federal Reserve, made some comments to that effect, that this could be a very, very deep economic depression and could be very long lasting, particularly if there isn't a stimulus package or several stimulus packages moving forward in Congress. So for that reason, I think the Fed will just read the tea leaves on how severe the economic downturn is, and they may address that with some changes in the terms.
And so with the population numbers, is there the option in this to bundle, let's say a few municipalities get together and achieve that population number, or is that just something not being looked at just yet?
I am unsure about how that actually could work. It might work if several smaller municipalities wanted to do that and then go through the state and get lending that way. The reason I'm unsure about that is each municipality has its own credit rating, and there are specific requirements around the credit rating in order to be eligible to participate in this facility. So if you had municipalities with a AAA rating and then some with a under a triple B minus rating, that might be very, very difficult.
How would you average that? Okay, together we have a B plus,
Right, exactly. And so that's why I think it might be a little tricky to join forces unless everybody has the same credit rating, and then you figure out how the liability would be apportioned if one municipality is unable to be able to pay back the loans.
And so one of the other things that you mentioned in your report, and you talk about this in context of tests and ways to test. So you say, in quote, when the Fed policed consumer lending for problems, it used a test called disparate impact. Can you explain that to our audience? What is that test? What does it look like? Why does that matter here?
Sure. So the Federal Reserve, obviously is a regulator. They regulate a variety of financial institutions. And for a fairly long period of time, there are several laws that have been in effect, regulations that have been in effect about access to credit, and access to credit being equitable across a variety of different demographic groups. This follows on the heels of a number of legal cases and research that found, for instance, that banks tended to discriminate against African Americans and Latinos and Asians who would have similar FICO scores to whites, but got inferior and subprime loans in a variety of markets, housing market, auto loan, et cetera. And so as a result, there are a variety of regulations and laws that require financial institutions to provide equitable access to the credit markets for a variety for a range of borrowers. And so what the Fed does, and a variety of other financial services regulators do, is they look at the data about who has been approved for these loans, under what conditions, and who has not been approved for loans, under what conditions. And what they're looking for is this concept called disparate impact, which means that you have a set of policies and practices or rules that appear to be neutral. So for instance, the underwriting algorithm at a bank for getting a home loan. Okay, that sounds like it should be kind of neutral. But the result is a disproportionate impact on a protected group. So that's what disparate impact is. And sometimes it happens not because there's something wrong with the algorithm, but because the lender who's taking the application makes a judgment and says, well, no, we're going to put this person in a subprime group, right? Or they're asking for a kind of documentation that makes it very difficult for those people to be approved for a prime loan. So there can be things happening around the algorithm that lead to disparate impact. So the Fed has this test, as do other regulators. So all we were saying is that, okay, well, the Fed already has that test. They apply it to financial institutions. It's actually something that they should apply here too, right? You're rolling out a new policy, and it's pretty uncharted territory. You want to know, okay, what is likely to be the impact? So they should be collecting data as this program unfolds in order to understand what impact it has on a variety of different subpopulations and cities, et cetera. And so that's what we were suggesting.
Well, I think that, and I know you mentioned it briefly in the piece, I think the thing that many people might be thinking of in context of that and trying to understand it is the practice of redlining when it came to
Correct.
Being able to loan in specific areas, but a literal red line being drawn around and saying don't loan within there. And then
Right.
coupled with the idea that, the presence of a bank in a community, banks don't make money when you store your money there. They make money when they lend you money and charge interest on that. And then that can be
Right.
really challenging for populations that don't have access to banking or have had a red line drawn around, or still the echo of a red line or a faint red line still present in that community. So
absolutely. You bring that up, and I think that's a really I think it's an excellent observation and something for us to keep in mind as we think about the legacy of how segregation actually has worked in the financial markets. And that's actually one of the interesting points that we made here in this report. So we showed that for every 10% more of a Black population you had in the city, you were 10% less likely to be able to qualify for the original terms of the Fed Municipal Lending Facility. And I want to give a little bit of history around that. So particularly on the East Coast, you had, obviously everywhere we had redlining, but particularly in the East Coast, as you had larger Black populations growing in urban centers. So let's take Baltimore, for instance. There were a number of moves to segregate those to continue to segregate those populations and to segregate services that they had access to. And so what happened in a lot of cases is you had these additional jurisdictions which were developed. So for instance, in Baltimore, you have Baltimore City, right? You also have Baltimore County. Baltimore County is wealthy and more white. Baltimore City is a Black city, right? And the reason the county developed was really to create segregation and to prevent Baltimore City from growing. Right? So the concentration of Black people in Baltimore City just went up and up and up with natural population growth, and because you had a lot of white flight. So that history is what leads to these these cities that have great concentrations of African Americans. And the more intense those moves were in prior decades to kind of isolate those cities and segregate them from everything else, the more likely they were to be Black and majority Black, and the more likely they were in population to be small enough to not qualify for the Fed's lending facility. So that's one of the things that we were talking about. And that is actually the long hand and long arm of racial segregation in these areas.
And yeah, just one more time, that number that you started with, for every 10% more Black the city's population is, it is 10% less likely to qualify for the Fed's program.
Right, under the original formulation, right.
That was just so alarming. And another thing that really caught my attention in your report under the original drafting of what the Fed proposed, and I quote from the report, in particular, none of the 35 most African American cities in America meets the Fed's criteria for direct assistance. They will be forced to go through their state governments and may be limited by that state's ability to access funds, and compounded by the state's politics. And we talked about state politics and the challenges there in, both time and ability. But bluntly put, the $600 billion question: how do we get better? How better, more equitable policy that ensures that most African American cities, or cities with high concentrations of African American populations, aren't cut out of this process simply because there are more Black people living there?
Yeah, so I think that's a great question. I think there are a number of ways that that could be handled. I think the first thing is, we all know this, I think, intellectually, but it's important to have people of color in positions of policymaking power. So it's important for the Federal Reserve to be able to call upon people who have expertise in that area. If they're not actually on the Federal Reserve Board, but they should have access to those folks, pretty ready access. That's the first thing. The second thing is, I think we've moved really as a society from a place where we just make policy and assume that the starting point is fairly neutral, to making policy where we think, okay, wait, there are already inequities, so there's a context here. So we need to really, we mentioned in the article, think about an equity scorecard, and I don't mean that literally like you're checking things, but more the concept, which is, what are the equity impacts of this policy? And I think that that is something that just needs to be part and parcel of the normal policy making process. And so the combination of having people who have a variety of perspectives that are in decision-making positions, plus having the standard operating procedure of always looking at equity impact alongside other kinds of impacts, and weighting it equally. I think that's a very important way of moving forward whenever you're doing any type of policy, particularly in the financial realm, because the financial inequities are so stark, actually.
Well, and I think in context of that, when you say that, it will be important for policymakers to actively use that equity scorecard, is the stark reminder still that equality and equity are two different things, so that when there's something that's just simply equal, it doesn't translate to equity. It doesn't
Right.
speak the same language.
Right. You're absolutely correct about that. I mean, equality is sort of, I always give this example. So you have two school districts, one which is really impoverished and the kids come to school hungry, and one where, the kids are, doing well and have every possible resource. So you put two science teachers in those schools. Okay. So that's equality. Well, you have a science teacher in school A and you have a science teacher in school B, it should all work out, right? But the kids in school A are hungry and haven't slept well, and they can't, even if a science teacher is a magician, they really just can't follow, right? And you have the kids in school B who are fine and they're able to follow at, whatever pace works for them. So equity is saying, okay, we have the two science teachers, and that's awesome, and we have equal, resources, educational resources, but we're also going to provide, free lunches and free breakfasts, and make sure those kids are well taken care of, and whatever other mental health services that they might need, or clothing, or whatever else. That's equity. So it gets them to the point where they can actually take advantage of this great science teacher, just like their peers in school B. So that's the difference, actually.
And that's such a great example to illustrate that simply, where, we just think if you have a science teacher in each school, everybody's going to come out the same. And clearly they're not, when you start to think about the density of all the things that happen to make a school happen and to have students attend a school, and you think of school taxes funding that, families living there, and so much other. And speaking of density, I don't want to lose sense of this too, because I know we mentioned, the 35 most African American cities. In your report too, you point out, and I don't want to give the whole thing away because I want to encourage people to go to brookings.edu to read this report. You say that it is, quote, as a result of both urban and rural and racial politics, many of the largest metropolitan areas lack single jurisdictions that meet the Fed's requirement initial criteria for this assistance. The entire metropolitan statistical areas of, and this is what shocked me, Atlanta, Baltimore, Boston, Pittsburgh, and Detroit all fail this test. And you go on to add not a single city or county in Georgia, Ohio, or New Jersey, America's densest state, qualify for that. So it really helps reveal just how limiting this initially was.
Right, exactly. It was extremely limiting. And when you think about Atlanta, right? I mean, Atlanta we think of as a largely African American city, but the actual jurisdictions, you're not individually did not qualify. You don't actually put them all together for the reasons that we talked about earlier about different credit ratings, et cetera. And so you end up in a place where, wow, major cities were not qualified. And so this was part of the critique generally that the Fed Reserve was getting from a variety of market actors in the municipal lending market. But I think it also serves to underscore just how devastating this would have been to large cities with large African American populations. And again, the reason we were concerned about that is that COVID-19 has really stressed these cities in particular, because huge portions of their populations have fallen sick with COVID and died, and they've had to provide services to that population. So that's where the concern comes from.
And some colleagues of yours at Brookings in the Metropolitan Policy Division have pointed out too that in addition to the public health aspect of hitting larger cities harder, it's hitting larger cities harder economically, that larger metro regions are also being stressed when it comes to the economic impact of COVID-19. And we're really seeing this dual-headed monster, and it's descending upon cities in two ways. With the Fed right now, and we see them making, we've seen them make the revisions in late April, and they're learning in real time. One of the questions that I had as I was reading this and thinking about it is, what can the Fed do? And it can, I think, of ability and what they can do, and they've done some of that to adjust the criteria to meet. And what should the Fed do? What's the right thing to do? And how do we use this, I guess, as the bigger question? How do we use this as a guiding moment to look at how we draft policy so that we're doing it better right now in real time, and then into the future? We can really use this as a learning moment.
Yeah, no, I agree. Several great questions there. And so let me talk a little bit about, what the Fed is able to do, and then what the Fed should be doing. And then we can talk about policy lessons after that. So the Fed is essentially acting as the lender of last resort for the US federal government, and now for state and local governments, and also for some corporate organizations. The corporate organizations and state and local governments are new areas for them to act in as the lender of last resort. So we're going to be learning a lot about what they do there. But the most important thing I think to recognize is that the Fed has really been trying to stay ahead of what is a looming economic depression. Their role in the US economy is to make sure that cash is flowing and that there are no bottlenecks, or dams where various entities cannot get cash. If we look back at the 2008 financial crisis, one of the main issues there was that some key markets, financial markets, actually were having trouble getting cash. So the Federal Reserve exists to make sure that cash is flowing. So it's doing about as much as it can in each of those sectors. It may have to do more, and the way that it does that is it takes money that is apportioned by Congress for loans, et cetera, and then it leverages that money and then uses that leveraged position to purchase these loans. So they are doing a lot. Now, what else should they do? I think it's going to be, and I don't think this is any, there's no mystery to this. I think they have to continue to keep their eye on the ball when it comes to state and local finances. Those are likely to deteriorate. I think that's just the reality. And so they might have to increase the size of the fund. They may also have to increase the length of time that the loans are out there and when payment is due on those loans. So I could see that changing considerably as things proceed into the fall and into the winter. With respect to what do we learn from policymaking? So I think the most important thing here is that we have a really diverse United States, and we have one which has a history of intentional brutality, intentional racism, some unintentional, disparities. But what COVID-19 has highlighted is exactly where those cracks are, exactly where that web of neglect is. And as a result of that, policymakers cannot continue to just be on autopilot. Like, for instance, they can't just say, well, we've always lended to XYZ kind of organization. I think what all policymakers have to do now is they have to now say the context is different. The context is one where there's a lot of neglect, and a lot of that has a very long history. And as a result of that, we need to take that into account when we are developing policy, because we don't want to exacerbate those inequities and disparities. I mean, the Fed can't fix that. That's not their role, is not to fix those disparities, but certainly not exacerbating it would be, job number one, I would say. But I do think it's a severely different perspective. Perspective needs to be now, we are in a world that is not equal, and it's obvious, and we need to make our policies we need to make our policies in such a way that we are acknowledging that.
Well, a crisis is a horrible thing to waste, and I think there's great opportunity here. And you reference other inequities the COVID-19 crisis is revealing, and some of the work your other colleagues at Brookings are doing. Can you shine a quick light there, point us in some directions of other things we need to be paying attention to, other
Sure.
folks we need to be following along and reading the work of?
Sure, yeah, absolutely. So a number of colleagues across Brookings, a range of folks have really been focused on COVID-19 and its disproportionate impacts on a variety of populations. But I'll name a few here. Obviously, we know about the disparities in health impacts. So populations that have tend to have disproportionate amount of pre-existing conditions. So those tend to be African Americans and Native Americans. They have fared particularly badly in this crisis. And in most cities and most states, African American populations tend to be hit at twice the rate that whites do in those states. So that's a pretty that's a huge difference. And my colleague, Rayshawn Ray, has done a number of articles on that and has really done an excellent job, I think, of kind of highlighting that. The second area, obviously, I think has to do with education. And so one of the interesting things, and I think it's actually, for me, pretty painful to see this, is that every school district knows they have kids who don't have access to the internet. I mean, every school district knows that. This is not news, right? But during COVID-19, when school districts have closed and have had to rely on online lessons of some sort, you now get a big spotlight on it and on the fact that there are households that don't have access to the internet or don't even have machines, right, to Chromebooks or, tablets or whatever. And I think it's pretty inexcusable that a lot of school districts just allowed those inequities to just exist and just kind of shrug their shoulders like, oh, well. And so now, it's pretty clear that that's part of the soup that we're in. And a lot of my colleagues have been writing about how do you move forward, particularly my colleagues at in the Brown Center for Education here at Brookings. How do you move forward when now you know, and it's really, really obvious, and nobody can say, oh, I had no idea, that there's, there obviously haves and have-nots. And though that fact that school districts have been continuing with classes online when they know there are kids that haven't even checked in since the middle of March, I mean, it's just really inexcusable. And so we have colleagues who've been writing about how do you create an educational system or systems, across the U.S. that really address these kinds of disparities. So great work that's being done there. In general, the digital divide is also becoming a huge topic. We always knew that there was a digital divide. Rural areas, I'm not just talking about African American areas, but rural areas tend to be left behind, as do areas that are populated by people who are poor and can't pay for internet and the machines, et cetera. So this is just not education, but this is sort of, now we've moved to telehealth. How do you have access to telehealth if you don't have an internet? How do you now apply for a job? I mean, if you don't have access to the internet? How do you apply for unemployment if you don't have access to the internet? I mean, you're literally going to go to the state labor department and show up there and fill out a paper form. So there are, I think there are a number of digital sort of disparities that have really come to the fore, and it's really important to recognize we have to cure those things because there are huge swaths of our populations that simply cannot participate in the economy, can't participate in the educational system, and that is going to be devastating for a country that's really going to rely on these populations for growth and for economic activity as we move forward. So I think that's another area. And then one of the, I think, interesting aspects of the whole COVID-19 kind of public health advice and public health direction is, very early on we were told that if you get sick or you're not feeling well, you should self-isolate, right? And so we have folks, that works well if you are affluent enough to have space, right? And if you are like 16 to a 2-bedroom apartment, or 8 to a 2-bedroom apartment, or whatever it is, you're not going to have that kind of space. And so even in the public health guidelines, there were a set of assumptions that were built into that that I think ended up being pretty devastating because you didn't get a set of public health guidelines that acknowledged basically, okay, there are going to be people who can't self-isolate or distance themselves from, and then to add an additional set of guidelines for those folks. It wasn't until much later there was like, oh, is it true that people who work in poultry factories and pick artichokes in the Central Valley of California, they're in like one shack and there's like 20 of them in bunk beds. Like, people didn't realize that public health folks didn't realize that that was actually an issue. And so we've also at Brookings kind of made sure that that has been highlighted. There also has been a lot of work in Brookings on what happens to those frontline workers, those essential workers, those people who are working in grocery stores, right? And what are the kinds of rights that they have? What has been the evolving scene of labor law and labor rights in the middle of COVID-19? So if you were in Amazon, working in an Amazon warehouse, and you're packing stuff, is it really necessary for those workers to strike in order for Amazon to recognize that they are human beings and that they should be treated properly and have the proper amount of distance between themselves and have the protective gear, PPE that they need? Should it really take that, right? So Molly Kinder in our Metropolitan Policy Department also has written a lot about that. So those are some of the areas where we've seen a lot of the disparities.
And it's so alarming of everything that's now being revealed. And, I think particularly with the last thing that you noted, the future of work, so much now is going to be considered about really the worker and what we're asking people to do when we ask them to do the tasks that, yes, they are getting paid for, but at what cost? What cost to them? What risk to them? And COVID-19 is really shining a light on that, as well as education, as you mentioned, and the digital divide, and so much more. We talked about what a lot of other people at Brookings are doing. We talked about your report that came out on April 9th. What's on the horizon for you? What are you working on now? What should we be plugged into? When are we seeing your byline again to make sure we read your next report?
Okay, well, great. Thanks for asking. I did not start this year thinking that I would spend a lot of time on COVID, and I am. I do think, as you said, you do not want to waste an opportunity. And I think COVID is an opportunity for us to really rethink some of the state and local spending and federal spending in a variety of different areas. So I'm going to be working on a number of pieces that provide suggestions for state and local governments about what are the things that they can do to create more equitable kind of economy, more equitable housing markets, more equitable opportunity structure, and more equitable healthcare structure within their localities and their communities. So that's number one. Number two, I'm also going to be writing about what does recovery look like. And one of the things that I'm particularly interested in is making sure that recovery does not look like what we left. So I'm not interested in moving to status quo ante, so to speak, like what we had before. I actually think it's important for us to take the lessons that we've learned from this particular crisis and make sure that we put investments in areas where they're really necessary. So to give you an example of that, there are a number of rural locations, and there are also a number of urban but poor locations where it's really, really hard to access a doctor. And we just need to fix that. I mean, that just needs to be fixed. And so I do think I will be spending a lot of time on focusing on, what does the recovery look like? And what are the ways in which we're going to be measuring whether or not it's successful?
I think that's such a great thing to be looking at, and I have tried to be mindful we are all eager to see post COVID-19, and I've been mindful to try not to use the language of when we return, just because I really do think that's so important. We have this moment, and now with so much revealed, to be better and to move forward, and not to return to where we were, but find ways to address all of the things that we're now collectively becoming aware of, during the crisis. And so glad to hear you mention that. And like earlier when you mentioned, telehospitals, and I've a handful of friends now have had doctor's appointments over the screen, but that means you need to have a screen and have the internet and have that ability to have a doctor that also has that ability. Dr. Camille Busette, this has been fantastic, and you've been so gracious with your time. And we started this conversation talking about the report that you co-authored with Aaron Klein at Brookings, improving the equity impact of the Fed's municipal lending facility, and what that looks like. Main points that you want people to be able to take away from that particular piece that you wrote, that our audience should be mindful as they continue to think about this moving forward.
Sure. I think the main point is that, when the lending facility was first announced, its original requirements eliminated all majority African-American cities and all major cities, actually, places that have really been most devastated by COVID-19. And that changing those requirements would get the loans to cities and to counties that really needed that support. So that was the main point of the article. The one thing I want to kind of leave everybody with as we wind down is, in some ways, this has been a very illuminating crisis. We've talked about some ways in which we're now confirming some of the disparities that have always existed, and they've obviously been worsened by this crisis. But one of the interesting things I think that we've come away from this is, with so many people unemployed and so many people dying from COVID. That the situation that people find themselves in is not of their own making. And that's a very important point for all of us to grasp. And I think it's a very important point of departure that we should hold up as we think about what the path forward looks like.
Dr. Camille Busette, thank you for taking the time to join us today for this Jefferson program. I do hope you're going to come back and we get a chance to talk to you again about all of the things that you are working on, but a big hearty thank you to you.
Thank you. A very warm thank you to you, Ben, as well. Thanks a lot.
And thank you to all of you watching along at home and tuning into later broadcasts for this. Thank you to read Improving the Equity Impact of the Fed's Municipal Lending Facility. Head over to the Brookings website at www.brookings.edu. You can find the webpage for Dr. Camille Busette there, other things that she's written, things that she's working on, and ways to follow up on that work. Any other ways that you want people to follow what you are doing, Camille? Anything that you want to plug or direct people to find out more information?
Yeah, sure. Actually, in June, we're going to be launching a blog that is really focused on how do we recover, particularly at this moment when we need to really embrace social inclusion. So you'll see that as well.
Excellent. And hopefully we can bring you back to talk about that. We'll highlight that at the Jefferson. Thank you for sharing that. And of course, to find out more information about upcoming and past Jefferson programs, as well as publications, head over to our website at www.jeserie.org. And be sure to like us on Facebook and follow us on Twitter. For the Jefferson Educational Society, I'm Ben Speggen. Be safe, be sound, and thank you for listening and learning with us today.
Thank you.